Yes, we are live. How you doing, friends? Coach Ernie here. This is the 0 Days to Expiration podcast. And this morning, actually all this week, we're going to focus on fundamentals. By the way, this show is shown every Monday, Tuesday, and Wednesday. And then each week we try to cover a related set of topics around 0DTE trading, and in particular, our style of trading, which is quite different than what most people are doing. It's actually a very professional way of trading, and we focus on that particular aspect. It is a way of taking asymmetric risk to reward, so very tiny risk for a large potential reward. And you're going to see through all of our presentations how that will materially affect how you look at trading altogether, quite frankly. And one of the things that we stress above all else is routine, consistency, discipline. These are the key factors that will make you successful. What I'm here to do is to help you become consistently profitable, independent. In other words, I want to make sure that you understand why you're taking these trades and what the edge is, and you're doing it on your own volition. You're not just following somebody's alerts. And to trade at a pro level. Those three things are our primary goal for you. So today, we're going to do something that will address what I typically address almost every single show, and that is the morning routine. And what are the things that we do and why we do them to set up our trades for the morning, typically in the morning session. And so I'm going to go through each one of those steps and explain it in detail. As every morning, before I do the presentation, I say, hey, we got to do that morning routine. It's sacrosanct. And as I said earlier, everything that we do is all about routine. So we're going to talk about that in detail. And then the rest of this week, we'll talk about each of the primary focuses of the trading routine, and that is preparation, execution, and reflection. So that's going to be our primary focus, and looking at the things from a deeper context, looking at the individual habits that we're building, and then the fundamentals that are behind each of those habits. All right. Given that, why don't we get started? Let's see, I got to get the presentation queued up first of all. There it is. Just going to make it a little bit bigger. Start on slide 1. All right, we're good to go. I don't know if it's going to go directly to there. Let's see what happens. No, it goes directly to the routine, but that's okay. And in fact, this is largely what we're going to be talking about this morning, but let me go to the presentation itself. There we go. All right. So by the end of this hour, you'll have a complete framework, and you'll know the math behind it, and you'll also know exactly what we're putting on at the open or in the morning session today. But before we can get into the mechanics, I want to remind you why we do this in the first place. And as I said earlier, it's all about becoming consistently profitable, independent, and trade at a pro level. So everything that we're doing is geared around those three concepts. That is our mantra. But today, we're going to go over the morning checklist, why we run it, and how it engineers a right-skewed return distribution. And you're going to see that in just a bit. And I've talked about that in the past. And what that means is how many of our trades result in losses, wins, and then what is the nature of those wins, and then how they're distributed over time. And that's super important because everything that we're doing is trying to manufacture a right-skewed distribution, which is actually the exact opposite of what most of you are doing today. You're producing a left-skewed long-tail distribution, which means that you're going after high win rate strategies that produce capped wins and large potential losses. And this is really the bane of the existence of every retail trader. It's what at first appears to be an intuitively good thing because you're making these small incremental wins at a high win rate. But then all of a sudden, that risk that allows that win rate emerges, and it bites you right in the ass. and causes you to wipe out potentially weeks or even months of gains. And it is what ultimately will ruin your overall drive to what you ultimately want to achieve, and that is compounding. So everything that we do is doing something that's the exact opposite. And isn't that the way it is for most professional methodologies? You very quickly find out that you've been doing everything the opposite of what the pros have been doing. And that's really the point. So why don't we move on, and let's see where we are. We're in slide 2. Right. So 3 things that we're looking for every morning. We're looking to establish how big our butterfly is going to be, the width, our directional bias, and where entries are going to be, and applying the asymmetry that we were talking about, that risk to reward. And as I said, that will all deliver a right-skewed P&L curve over time. We're also very concerned about our position sizing. That is a critical element and probably deserves, well, I know it, not just probably, but it will deserve a complete hour where we'll talk about position sizing and how we calculate it. But that in general, our position sizing is about 1% of our total trading capital, and that's designed and engineered specifically to control our drawdowns. And we'll also look at the fly on the wall and how we use that to choose convex trades, and I'll describe that in a little bit. But here's what we're after: the right-skewed distribution of returns. This is really what it all comes down to. Small losses, small to medium winners, and fat tail winners. The fat tail, that is the goal. Now, I want to be very clear. That's not what we're trying to achieve every day or trying to manufacture a fat tail. These winners and losers all come as a result of probabilities, and we accept those probabilities. It's a key point. If you're sitting there thinking that your job is to get inside the butterfly profit tent every day, you're dead wrong. That is not what it's about. The point isn't being right more often. It's being bigger when right than when wrong. So in other words, yeah, we accept that we're going to be 50-50 traders. 50% of the time we're going to be losing, and 50% of the time we're going to be winning. We just want to make sure that the losses are much smaller than the winners. And if we're 50-50 and that's our result, we're going to achieve exactly what we're after, and that is a bottom left, top right equity curve. So I want you to hold this image in your head, because everything that you do is going to revolve around that. And ultimately, when you're doing the analysis of your returns, this is what you want to achieve. And if you're not achieving it, you got to figure out why. If you follow our process, our methods, you're going to achieve this. Of course, it's going to take practice, making sure you have that routine and the habits that constitute that routine, and then practice the fundamentals of each of those individual habits. And I know that I'll sound like a broken record when it comes to that, but that's what a coach is for. I'm here to show you how to achieve success. And it is through practice of those fundamentals. That's the goal. This is the shape right here, a positively skewed distribution. Now, just look at it. Small losers on the left, and the bulk of those small and medium winners in the middle. And over here on the right, let's see, I'm sure I'm showing this on, yes, I just want to make sure, right there. Those huge fat tail winners. Now, I want you to listen carefully. As I said, again, a lot of what I do is repetitive, but it's important because I'm trying to build those neural pathways in your head so that you get this stuff. So listen carefully. We are not trying to be right more often than we're wrong. That's a sucker's game. And the markets won't let you do it consistently anyways. The markets are there trying to kill you. We're trying to be bigger when we're right than when we're wrong. Average losers are small, average winners asymmetric. Now hold that in your head. Every step in this checklist is engineered to create this distribution. All right, next slide. All right. We showed this at the very beginning, and I call this the VIX playbook. It's what everybody within the 0DTE service are looking at every morning. It's really determining how we're going to approach the market that day. And so typically we're taking trades in the morning session, which I define as from the open, actually it's even before the open, until about 12:30. And then there's the afternoon session, is 12:30 to 2:30, and then the closing session from 2:30 to 4. Primarily we're entering these trades in the morning. I would say if you're going to peg me for a time, which is impossible to do, but I would say most of those trades happen in the 10 o'clock to 10:30 range, but don't look at it as that's when your ideal position is, because it could be right after the open, it could be 15 minutes later, it could be a half hour later. It's anywhere inside of that morning session. That's super important. All right. So first of all, when we're looking at the VIX, and why are we looking at the VIX? We're looking at the VIX to determine how wide we're going to construct our butterflies. And if you're wondering why we change the width of our butterflies, why we adjust it based on the VIX, I would say go back to some of our previous presentations where I talk about exactly why we're doing that. And it all has all to do with the rate of premium decay and how much premium is available to you in that day based on volatility. Volatility is the primary driver of all of this. All right. So I break down the VIX into three basic regimes: Zombieland, Goldilocks, and Chaos. And the Goldilocks zone is, as it sounds, it's just right. It's pretty big zone, so I break that down into two additional subzones, or Goldilocks 1 and Goldilocks 2. And depending on where the VIX is in one of those regimes will determine how wide we're going to make our fly that day. All right. Zombieland is between or lower than 17 on the VIX. Goldilocks is between 17 and 32, and Chaos is above 32. And we split Goldilocks in half from 17 to 24 and a half, 24 and a half to 32. That's what we call Goldilocks 1 and 2. So today, the VIX is at 19, so it's sitting in Goldilocks 1 area, right down there. And so that means that we're going to be choosing a butterfly that is between 30 and 40 wide. And that might seem super wide to you. But don't worry about that. We talk about that as well in other previous presentations where I describe exactly why we're going wider. And it's all about the optionality that affords and giving us the proper gamma. Now, I'm not going to go into it in great detail here. Let me just say that wider is better. Trading further out of the money or a higher risk to reward is also advantageous. And everything that we do is trying to maximize that fact. Now, you'll see that it is a range between 30 and 40 wide. How do I know what end of that range to be on? That's using another tool. It is also using a butterfly, an at-the-money butterfly that we look at pre-market using the ES typically. It doesn't matter. You can use the ES or the SPX. It all depends if your broker is able to give you proper pricing. And I find that using the ES is more reliable. Most brokers don't have information about the SPX pre-market. Use the ES, putting on a 50 wide fly, and then check out what the debit of that fly is. That debit is going to determine whether there's a large amount of energy or lacking in energy coming into the market. And it may also set up an additional trade that we call the big ass fly. Now, we're a little late on that this morning, and I'll talk about what the big ass fly is as a separate edge case morning trade. But we're primarily looking at that 50 wide at the money fly to determine what the level of localized volatility is by looking at that debit. That volatility is going to control the amount of that debit very precisely based on that level of volatility. And that will set you up for whether you're leaning narrower or wider on that range. So should we be going 30 or 40 wide? And I'll give you a demonstration of that right now. We'll go to our Thinkorswim and take a look. Now here I have a 50 wide at the money fly. And you can see that the debit is right around a little over 25. Now, pre-market, that debit was a little under 24, was at 23 and a half or so. So it's already had experienced some premium decay. But we use that debit in the determination for our width, and I'll go back to the VIX chart. You can see, as I said, 30 to 40 wide. Then we look up here in the upper left. We're in Goldilocks 1. Now, where is 25? 25 is over here. So what we're saying is that, I'll be pointing right to it. Right over here, here's Goldilocks 1, 30 to 40 wide. 25, the debit is right here. So we're in the middle, 30 to 35 wide. So that's where we want to be, somewhere between 30 and 35 wide, probably closer to 35 wide. I always opt for leaning towards the wider end of the spectrum. So there's our width. I know, we did a lot of stuff just to get to what that width is. By the way, if you're watching this and you enjoy this content, you think it's valuable, give it a thumbs up. I've already noticed that there are a bunch of people here providing comments. I'll try to go through them as best I can. What doggy? The doggy wants to go out. I can't let you out right now. You have to wait. All right, let's see. I'm just going through the comments now. Statement I told you you have to. Okay, excellent. Why not use the VIX one day? You can use it. I've just standardized on the VIX, this particular VIX. If you want to develop your own, look at that one day. I'm more interested. Go away. Sorry. She's just sitting here crying at me. And I tried to let her out earlier, but she just hung around the door and then decided to come in. She probably sees the neighbor or something next door and wants to go bother her. Here. We'll have to demonstrate here. Come here. Everybody needs to see you. Yes. Come here. Come here, girlie. Yes. Come here. Yes, that's a good girl. That's Zuri. Zuri the Ridgeback. We have Obi over there. He's not so wanting right now. All right. Back to business. So we've chosen our width. All good. And we'll go back to, and we know what level of that width we want. This morning there was an opportunity for a big ass fly trade because we were below that 25 level. That really depends on whether or not there was an economic report to report. I don't have that information right now, but typically what we're looking to do is put it on just before an economic report that usually comes out at 8:30. And if the report, regardless of what the report reports, we're looking for a vol crush event right after there and then taking that in the big ass fly. And typically you can pull out of that anywhere from $2 to $3 in very short order. And then we're out of the trade. And that's, so the big ass fly is used both as an indicator and also an edge case trade. Now, there are other edge case trades that we could encounter here depending on where the VIX is. You'll see we have Time Warp and Batman. Time Warp is really meant for much lower levels of volatility. We're not really quite there yet. And because of the rate of premium decay that happens, or increased rate of premium decay that happens in low volatility, we might consider, instead of doing a 0 DTE trade, go out to 1 or even 2 DTE if the volatility is low enough. That's because all of the premium has already decayed, and we want to capture that by going out a few days or a day. And on the other end of the spectrum, when we start getting up into the upper ends of Goldilocks or into Chaos Zone, we start looking at the Batman, and it starts becoming more desirable, should we say. And the Batman is where we put a butterfly above and below the market. I want to let her out, but then I have to forget it. It's not worth it. I was hoping my son would drop by today and do that, but he might not be here until later on. All right. Next step. We got to go back to the presentation. Zuri was a distraction. And to the presentation. Okay. As I was saying, the big ass fly is a 50 wide at the money butterfly, typically taken with the E-mini S&P futures. You can also use the SPX, but I'm more interested in whether or not there's proper pricing on your options chain to use it. A lot of times if you put the SPX on, you might be looking at stale data if your broker doesn't supply fresh SPX data pre-market. And it's almost like looking at the tape, quite frankly. And it's an indicator that I've developed over the years, and it's super reliable. All right, and we already talked about the big ass fly becoming a trade, whether there's an economic report and the BAF debit is below 25. That's super important, below 25. And the reason is that when it's below 25, that gives us the proper risk to reward and also a flat enough gamma situation that it's not going to throw us out of our trade should the trade go awry. And I'll do a separate show that's specifically on the big ass fly and show you how you actually put the trade on, how you manage it, take profit, and so forth. And if there is ever an opportunity or the reasons why we wouldn't hold it going into a market open. All right. So let's go to the next thing on our checklist. So first thing on our checklist, as I said, was width. And we've gone through that in great detail. The second is, which direction are we trading? Are we trading bullish fly or a bearish fly? Are we trading a call fly above the market or a put fly below the market? And this is a lot simpler than you think. And a lot of people think that I need to select direction. And that couldn't be further from the truth. Or select direction thinking that I know which direction the market's going to go. Let me just say this. We do not predict the close. That's impossible. We simply identify the trend and we lean with it. Using maybe a simple moving average. I use the Hull moving average on a 21-day period only because my hypothesis is that a period of 3 weeks typically establishes a trend, so that's why I use it. And if it's pointing up, I go bullish. If it's pointing down, I go bearish. Now, this edge is relatively small, but it's important. We are trying to capture the average bigger move when the trend is right. But the honest truth is, up or down, inside a trend is still 50-50. So even if you looked at a longer term trend and counted all the up days and down days, you would still see that about 50% are up and 50% are down, regardless of which direction it's going in. So that's further evidence that you cannot pick the trend, or you cannot know what that trend is going to do that day. It's not a guarantee that it's going to go in your direction. You might think, then why do I do it? And as I said, we're trying to go with the average move that goes in the direction of the trend tends to be larger. And so that gives us a slight edge, getting a little closer to that profit tent and giving us a higher return. That's why we choose the trend. Not because we're thinking that we're absolutely going to nail the direction. Again, that is impossible. We're not trying to predict where the market closes today. That's because nobody can. Not me, not you, not the guy on TV, not the guy with the algo. If anyone could reliably tell you where the market would close at 4 p.m., that method would be famous. It would be everywhere. It isn't, because nobody knows. So what do? We identify the trend. We lean with it. A basic moving average is plenty. Doesn't matter which one. Pick one. Like I said, I use the Hull moving average. In TradingView, they have the Hull suite, and it gives you this nice big wide moving average bar, and so it's easy to see. And then they colorize it depending on the direction that it's going in. And the edge is small, but it's real. And when you trade with the trend, you can capture the average bigger move in the direction of the trend, and that's it. We profit on the average, not on the certainty. Now, here's the honest part, and I want everybody to be watching to understand this. Up versus down, inside a trend, it's still about 50-50, as I said. So I'm going to repeat it. You notice that I repeat things over and over again, and I have to, so that it makes its way into that thick noggin of yours. A trend today is all about averages and the bigger move in that trend direction. So even when the market closes against our bias, we can still make money on an intraday swing. So that's the interesting thing. Let's say that we're choosing bullish and then the day ends bearish. I've often found that, especially in volatile markets, you'll have these intraday swings and you still get a trading opportunity in the direction of that trend and make profit and then get out, and then the market can still end up negative. There was a good example of that just the other day. Let me go to that. So I have to go to TradingView. And we'll look at Thursday. I believe that is Thursday. So yeah, Thursday. And if you remember, you wouldn't know, on Thursday I didn't do a show, but prior to, in our coaching session, I had pointed out that in my coaching service, in our fly on the wall service, I had marked up this and put it into our Discord. And I said, we're looking at a pullback to one of these levels. And this is the morning session right here. And you can see that it pulled back right to this level right here. And that's where we took the trade. And most traders took that and they were profitable. Now, it just so happens that we were looking for a bullish trend. But let's say in this particular case, we were able to capture it. But you can see that the market actually ended up lower. Now, some people might say, why didn't you choose the bearish trend? Because I didn't know it was going to go bearish. Did you? I don't think anybody did. And it moved pretty drastically. But I have no way of being able to predict that. But I do know that we were able to get out of this trade with probably 100% return on our risk. All right. So there's a really good example of why you just stick with the trend, take the trade, and then be happy. And you'll do well. She's still crying. I don't know. Are you busting a gut? Oh, boy. We'll try to get through this really quick, and then I'll be with you. All right. Next step. So we have width, we have trend, and then the last is the trading event. And we look at volume profile to find market structure to determine where we're likely to have a trade. And so here we go, volume profile and structural markup. So I'm going to go back to TradingView and show you that you can see this market, I have this all marked up. Girlie, hold on. I'm getting the feeling that I'm going to have to just let her out. Hold on a sec. Come on, just stop. Fortunately, I have a very large property, and she can just go out the back, and then she might drift over to the neighbor's yard, but hopefully she'll do her thing and come back. But she ain't crying at me right now. All right. Let's take a look at this. These horizontal lines here are markup that I've created that have picked off structural levels. And you can see in here, I'm indicating in the morning session with the cyan arrows where we're likely to see a pullback into one of those structural levels, and then that creates the trading event. And this is a perfect example of that right there. Now, I also was prepared if it came down to one of these other levels, which it never did. It actually just zipped right through them and came all the way down to these levels down here. But I didn't anticipate those, and they were outside of our morning session, because the morning session is where we're typically taking those trades in here. So you can see, here's the one that worked out. And we can see a similar thing that happened here on Friday. I had pegged one of these levels as being our entry event, and you can see how I put this box here. This is where I was talking to the group and during our coaching session, saying that was the opportunity right there. And so it pulled back into a structural level in the morning. You take a trade above with an out-of-the-money butterfly, and you profit big time. This trade, I'm sure, produced huge profits for some people. That's exactly what we're doing. Now, when I am looking at the structural levels, I am marking them up in a much larger time frame. Typically, a daily chart, and you can see all the different lines that I have in here. Let's see if I can get that all in. Okay, so I've marked up these, and I'll go over probably later this week how I actually do this markup, so you can see. But this is a daily chart. Obviously, I can't see in a 5-minute view where all these opportunities are happening, but they're all based on historical volume levels. We're at all-time highs, so the volume profile is a little bit sketchy in that it's not as mature, but it's still important. The Trading Den says, I only made 412% return on investment on that trade. Yeah, that's typical too. So there's a member saying that made 400% on one of our trades. And that's really typical. Often you'll see people making anywhere from 25% to as much as 1,500% on our trades. And that's the key. That's the amount they made relative to the risk that they took. So let's go back to the presentation. So what we're not looking for when we're marking up the volume profile, we're not looking at POC, we're not looking at value area high or low. Those, as you've probably seen in a previous presentation, I totally debunked them as completely arbitrary and useless, and they are a lie. If you've been working on POC or point of control or value area high or low and thinking that will provide you with some kind of support or resistance, it's just not true. They are arbitrary levels that have absolutely nothing to do with structure. We'll go over structural analysis in a future episode. We'll go into great detail, but it's all about finding the edges of nodes and the deep crevices. That is where you're going to find market structure. And I just showed you the lines that I had, and you could see clearly that's where the market is pulling into and finding support or resistance. So the proof is in what I've showed you. All right, we already talked about the bath. We traded with the trend, volume profile. Now, when we move into one of these structural levels, that's what we call a tradable event. And if we were to go back to that trading view and to the 5-minute chart, that was the tradable event. I'm pointing at it right there. If it will help, I'll do this right there. The pullback into, or the pull up into a market structural level. Oh, by the way, when we're zoomed in, after I've done the analysis with these levels, I really don't need the volume profile anymore. It's not really useful. So we just focus on these structural levels. And you can see very clearly how the structure comes into play everywhere here. But that's what we're looking for. We're looking for that pullback, and then when we get there and it is showing us, and there's a number of different ways that it can show us that is the level of interest. And even if you miss it and it goes down to the next level and hits there and you get in a little early, don't worry about that. I've profited plenty on missed levels. It doesn't have to be perfect. It's just that if we can capture the bottom or the ultimate level where the market finds support or resistance, you're going to maximize the trade that you're going to get into. Now, when we get in here, because we're bullish, we're putting on a call fly above the market. And you might want to know, how do I know what strikes we're putting on, Ernie? I don't know what strikes that I'm putting on. I really don't. And it doesn't matter. All that matters is that I put on the proper trade with the proper risk to reward, or convexity, or asymmetry. And that's another slide that we'll get into here in a second. Let me move over to that. Back to the presentation. All right. We put on a trade that has extreme asymmetry. We have something that's called the 10% debit rule. And that means that I will not put on a trade that has a greater than a 10% debit, or 10% of the width. The debit cannot be more than 10% of the width. And we'll typically go down as low as 5%. But a 10% of the width debit would result in a 1-to-9 risk to reward. Probably sounds crazy to you, because you're typically looking at a 3-to-1, never mind 9-to-1. That's a 27 times difference between what you normally put on and what we put on. And that's the key. And I'll even go further. I'll go down as low as 1-to-18, 5% of the debit. That range is the sweet spot for what we're looking. That's going to give you the proper risk-adjusted returns and the proper optionality in your trades. And inside that range, you're going to find there's going to be what we call the convexity of debit. And I'm going to point that out by going to our fly-on-the-wall tool so you can see exactly what that means. And that means going right. No, that's not where we want to go. We want to go here. All right. So this is the fly-on-the-wall tool that I've developed. And over on the left-hand side, you'll see is the convexity heat map. And if we're choosing a 30 wide fly, I'm looking for a butterfly that has the proper risk to reward. And I got to log in. It's a secure app, by the way. So if I'm looking for a 35 wide fly, as I said, I'm not going to pay more than $3.50. That would be the 10% debit. The the coloring or the gradient here is going to draw me to where those opportunities are. And so 35 wide, these are all the prices at the center strike of the butterfly. And so I can see right here, this one right here is 379, but this one right here is 272, just one strike different. Now, if you're going to put a fly on, and then down here is only $2.15. That's crazy. So you can see that the price change is drastic just from one strike to the next. So if you were going to put a fly like this on, would you choose 312 or 425, or would you choose 230 or 150 even, where the price drops off dramatically? It's only another strike or two out. It's not going to change the profit curve all that much, but it's going to change your risk-adjusted return dramatically. And if you can keep or always put on those types of trades that's what we would call the convexity point, where the risk to reward, the difference between the price of one fly next to the other changes dramatically. That's what we call a convex relationship, and that's what this helps identify. And so putting on such a trade is as easy as finding it, clicking on it, and putting it in the analyzer. And then I can send it directly to my Thinkorswim or whatever platform that I'm using. I can literally send it to the Thinkorswim by just clicking right here and copying the trade and then pasting it into my Thinkorswim. So that is the proper trade that we're looking for. All right, go back to the presentation. We're looking for convexity. And I'll go into the math. I've done this in previous presentations, talked about why we look for that extreme risk to reward and why it pays. The interesting thing that a lot of people don't realize is that the wider you make your fly and the further you push it out, and even going for those higher risk to rewards pays better. Literally pays better for the same move, even though it's further out. And that is, again, another one of those non-intuitive things that people have a hard time wrapping their heads around. But you'll find that by pushing the fly further out, making it wider, will give you a better overall return in the long run. You're going to make better risk-adjusted returns, and that's what we're after. That means you'll be able to also invest more in those trades and make more, and they will pay off better. And when they do pay off at their max, it'll be an unbelievable return. The end result is the kind of distribution of returns that you're looking for. You will create a right-skewed long-tail distribution, and your equity curve will be nice and smooth and consistent going from bottom left to top right by playing these types of trades. That is the key. That's what we're after. Oh boy, I'm not getting through the entire presentation. Let's see. Here's a picture of exactly how those trades would typically distribute by superimposing an actual or a depiction of a butterfly. You can see that most of the returns that we get, almost 40% of them, are out here in zone 1, where this is at the money where we would take the trade, where you can get anywhere from a 50 to 250% return. Now, you saw that one of our members said, hey, I got over a 400% return. That probably meant that they were in this area here in zone 2, where you typically get anywhere from 250 to 450%, or even higher. And if you get right inside of zone 3, you can make as much as 1,500%. That would mean that you went all the way to the end of the market and it was a near pin trade. But that's entirely possible. It happens not all the time. As I said, about 2.5% of your trades end up being one of those trades. Getting inside the profit tent is a relatively low probability event. It only happens about 12.5% of the time, which is essentially the same amount or same probability of getting in the money on a long call or a long put. That's where you're getting intrinsic value too. So this trade follows along with the same kind of pricing dynamics that you see in simple long calls or long puts. And so so you wouldn't be putting on a long call or a long put thinking that you're going to get in the money every time. That's just not realistic. And it's the same thing here. In fact, it follows, like I said, the exact same dynamic. And again, this is where this distribution of returns results in that right-skewed long-tail distribution. Now we're really moving along here. Let's get to, position sizing. I didn't really talk about that, and we'll dedicate an entire presentation just to position sizing, what the math is behind it. But typically we're not taking more than 1% of our trading capital, and what that will help us do is limit our max drawdown. It will give us a small enough risk profile that we're not really sweating losses. 50% of our trades go to loss. We don't manage them. We don't manage them because the losses are small. That size, that position size, is engineered specifically to limit our drawdowns to a very deterministic level. And for me, that is around 6% maximum drawdown. I never draw down below that. Typically, I'm staying somewhere on average of a 1.5% to 2% drawdown. And then at a max, a 6%. Now, gold standard for most pro traders is a 10% drawdown. We're well below that, so we're super conservative, but it works. Now, we'll go over that, as I said, in a future presentation. So let's go over everything that we're doing. The 3 things, possibly 4 things that we're looking at every day. We're looking at the VIX regime to determine how wide we're going. We're looking at the BAF debit, or the big ass fly debit, to determine whether we're on the weak side or the strong side of that width. We're looking at the trend to determine whether we're bullish or bearish, call fly or put fly. And we're looking at structural levels to determine where we're likely to have a tradable event. So there you go. There's all the conditions. That's the 4-point checklist that we do every morning. So when I start one of these presentations every morning, I talk about these things. I spend, maybe 2 or 3 minutes. We get it done, and then we know exactly what, when, and where we're going to trade that trading day, that morning. All right. So this is a full-service platform for zero DTE traders. If you're interested, you can go to flyonthewall.ai/try and join our observer tier, which actually has full access to every part of the application and the Discord and the service and the live streams, everything. And you get that access for 4 weeks. So give it a shot. You won't be disappointed. Again, morning checklist with bias entries, and then conditional, where we are. That's a conditional trade. It could be the big ass fly or not. And what our risk to reward is, and our position sizing. That's it. All right, let's see. I think I just made it just under, or we're right at 10 o'clock. Excellent. That's it, friends. Thank you very much for joining me. Thank you for the comments in there. All U.S. dog owners understand exactly. Thank you. All right. We'll be back tomorrow with another presentation. And as I said, this week, we're going to be going over the fundamentals of our strategy. Thanks all. I hope you all have a prosperous trading day. Take care. Peace.